Hey everyone, welcome back to Corporate Decoder. Today, L.P.B.B.U just filed its first quarter 2026 report, and I am seeing some interesting tidbits about their race to find a business. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is essentially a shell looking to buy another operating company, and their clock is ticking to do so. Let us dive straight into the balance sheet as of the 31st of March 2026. Right away, what stands out is the cash and marketable securities held in the trust account. That number is over $245 million. This is the money they raised from their initial public offering, set aside specifically to buy another company. However, look at their regular cash balance outside of this trust account. It is just over $140,000. That is not a lot of operating cash. Their total liabilities are about $11 million, with a big chunk of that being a deferred fee payable of nearly $11 million. This fee is linked to their initial public offering, and it is not paid out unless they actually complete a business combination. Now, let us look at what they earned and spent. For the 3 months leading up to the 31st of March 2026, they had a net income of almost $2 million. This sounds good, but do not be fooled. This income is almost entirely from the interest earned on their trust account money, which was over $2.1 million for this period. Their actual operating expenses, general and administrative costs, were around $194,000. So their operations are costing them money, but the interest from the trust account is covering it, and then some, showing a paper profit. Looking at how their cash moved for the first quarter of 2026, they used about $109,000 in operating activities. Again, this shows that their day-to-day operations are costing them cash. The net income that we saw was more than offset when you account for the adjustments to cash flow, primarily the interest from the trust account being added back. Let us talk about those Class A ordinary shares. As of the 31st of March 2026, there were 23 million of these shares. What is crucial here is that these shares are redeemable. This means that the people who hold these shares can choose to get their initial investment back if the company does not find a suitable business to acquire. The redemption value per share was about $10.67 at the end of March 2026. This is a really important number because it represents how much money is essentially set aside for these shareholders. Now, let us discuss their liquidity and whether they can keep operating. As of the 31st of March 2026, they had about $140,000 in operating cash and a very slim working capital surplus of just under $9,000. This is a clear sign that they rely heavily on the money in the trust account to function while they look for a business. The report itself raises a big concern. Management has determined the company's liquidity condition. The date of mandatory liquidation and subsequent dissolution raise substantial doubt about the company's ability to continue as a going concern. This is a classic warning for companies that have not yet found their business yet. They have a deadline, and if they miss it, they have to start dissolving. Let us rewind a bit to their initial public offering, or IPO, on the 9th of October 2024. They sold 23 million units at $10 each, bringing in $230 million. Each unit had one Class A ordinary share and half of a redeemable warrant. The money from this IPO, after deducting fees and costs, went into that trust account we talked about. The total offering costs were over $15 million. This section highlights transactions with their sponsor, Launch 2 sponsor LLC, on May 13, 2024. The sponsor put in $25,000 for 5.75 million Class B shares. These are often called founder shares, and they usually come with more voting rights, but are subject to lock-up periods. It is also worth noting that they have an administrative services agreement where they pay about $12,500 a month for office space and support. This shows ongoing operational costs even before they acquire a business. Here we see information about their commitments. A major one is the underwriting agreement. The underwriters who help them sell shares in the IPO are entitled to a deferred fee. This deferred fee, which is about $10.95 million, is only payable if they successfully complete a business combination. This is a huge incentive for the underwriters to help the company find a deal. They also mention risks related to economic conditions, market downturns, and geopolitical instability. These are standard for any company, but especially so for a special purpose acquisition company, or SPAC, like this one, whose entire existence depends on finding and closing a deal in a stable environment. This part goes into detail about their share structure. They authorized 500 million Class of shares, but as of the 31st of March 2026, only 23 million were issued and are subject to redemption. They also have 5.75 million Class B ordinary shares issued and outstanding. These Class B shares, the founder shares, will convert into Class A shares if a business combination is successful. The warrants are also detailed here. They have public warrants and private placement warrants, totaling over 18 million warrants. These warrants give holders the right to buy Class A shares at $11.50 each. Looking ahead, this section tells us what happened after the 31st of March 2026. For this filing, they state they did not identify any subsequent events that required adjustment or disclosure. This means nothing major happened between the end of the quarter and when they filed this report. Now, for the management's perspective, they are very clear that they have not engaged in any operations or generated any revenues to date. Their main goal is to find a business to combine with. They are focused on technology and software infrastructure companies, particularly those serving financial services, real estate, and asset management. They mention the deadline for their business combination is the 9th of October 2026. If they do not find a target by then, they will have to liquidate the trust account and distribute the remaining funds back to the shareholders. This going concern section is critical. It reiterates that the company's ability to continue as a going concern is doubtful unless they complete a business combination before their deadline. They plan to avoid this by finding a deal, but the uncertainty is high. If they fail to do so, all operations will cease and the company will be dissolved. It is a stark reminder of the high-risk nature of SPACs. Historically, about half of microcap SPACs that struggle to find a deal end up delisted after a liquidation. For a $1,000 investment in a company like this, if they liquidate, you probably get close to your initial investment back, but there is no growth. Finally, you see the exhibits. These are the supporting documents for the report. We have certifications from their CEO and CFO, which are standard for these filings. Overall, Launch 2 Acquisition Corp is in a race against time. They have a large sum of money in trust, but very little operating cash. Their entire future hinges on finding and successfully merging with a business before October 2026. The interest income from their trust account is keeping them afloat and showing a profit on paper, but the real game is finding that target. The biggest challenge for them is the limited time frame and the current economic climate, which can make finding the right acquisition target and getting shareholder approval more difficult. What I am actually looking for next is any news about potential target companies. Alright, that is our breakdown of Launch 2 Acquisition Corp. Its latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.